Let's go straight into the risks, because with Kraft Heinz, the big question isn't whether people will stop buying ketchup or mac and cheese. The real risk is whether the company can defend volumes, rebuild brand momentum, and keep margins stable in a tougher consumer environment. The biggest risk in 2026 is volume decline and weak brand momentum. In consumer staples, you can raise prices for a while, but eventually consumers respond, either by buying less, trading down, or switching brands. If volumes keep shrinking, revenue quality deteriorates, and it becomes harder to grow earnings sustainably. Closely connected is the risk that pricing power normalizes and promotions return. Over the last few years, many staples companies benefited from broad inflation. They could push through price increases. But as inflation cools, retailers often demand more promotions, and competitors start discounting. That can pressure margins and make earnings growth harder, even if headline revenue looks okay. Another major risk is input cost volatility. Kraft Heinz is exposed to commodities and packaging, things like dairy, meat, oils, and transportation. If costs spike while pricing power weakens, margins can compress quickly. In a low-growth staples business, margin swings matter a lot. Then there's private label competition. Store brands have improved significantly, and when consumers are price-sensitive, private label gains share. Kraft Heinz needs its brands to justify a price premium, and if that premium looks unjustified, share losses can accelerate. Execution risk is also huge. The bull case depends on better innovation, better marketing efficiency, and consistent operational improvement. But turnarounds in packaged food take time, and the risk is that investments don't translate into higher volumes, or the company ends up spending more just to maintain share. On the financial side, leverage is a watch item. Kraft Heinz has worked on improving the balance sheet, but debt still matters because higher for longer rates increase interest costs and reduce flexibility for buybacks or aggressive reinvestment. Finally, there's portfolio and impairment risk. Packaged food companies sometimes have to admit certain brands or categories are structurally weaker than expected, leading to write-downs, divestitures, or strategic shifts that can create uncertainty. Kraft Heinz's risks in 2026 are less about a sudden collapse, and more about slow erosion, declining volumes, higher competitive intensity, and margin pressure as pricing tailwinds fade. Now let's switch to opportunities, because with Kraft Heinz, the upside is not just about selling more ketchup. The real upside is about strategic change and whether the company can unlock value in a business that the market currently prices like a slow-growth staple. The biggest opportunity in 2026 is a potential breakup or separation of the company. Investors have been increasingly focused on the idea that Kraft Heinz may be worth more as multiple focused businesses rather than one large combined portfolio. A separation could unlock value by improving capital allocation, sharpening management focus, and allowing each business to be valued on its own fundamentals, rather than being dragged down by the slowest categories. A second opportunity is margin expansion through productivity and simplification. Kraft Heinz has historically had room to improve efficiency through supply chain optimization, SKU rationalization, and better procurement. Even small margin gains can matter a lot in a mature staples business because the market rewards stable, improving profitability. Third is volume stabilization. If pricing pressure eases and consumers adjust to the new price levels, volumes can stop falling, and even modest stabilization can change sentiment quickly. For a company like KHC, the market doesn't need strong growth to re-rate. It needs proof that the business isn't slowly shrinking. Another key opportunity is renewed brand investment and innovation. If marketing becomes more effective and innovation improves product mix, Kraft Heinz can defend shelf space, regain pricing power in select categories, and reduce the reliance on discounting. That's how staples companies move from commodity-like to brand-driven again. There's also the balance sheet angle. If KHC continues deleveraging, it increases flexibility, more room for buybacks, strategic investments, and higher confidence in the dividend. That matters because staples investors care a lot about stability and capital returns. Finally, if these pieces start to work together, breakup optionality, improving margins, and stabilizing volumes, the stock can see multiple expansion. Even a modest re-rating can drive strong returns when the starting valuation is low and cash flows are resilient. KHC's opportunity set is about value unlocking and confidence rebuilding, and the potential breakup is the highest upside catalyst if it actually happens. Now let's bring everything together with valuation and key metrics, because Kraft Heinz is one of those stocks where the numbers look cheap, but the market is clearly demanding a discount for uncertainty. Start with the long-term reality check. The 10-year annual return is negative, about -6.4%. That tells you the market has punished this stock for years, not because the company disappeared but because growth, margins, and investor confidence have been inconsistent. At the same time, volatility is extremely low. With a beta of 0.06, KHC trades more like a defensive staple. Investors aren't buying it for explosive upside, they're buying it for stability and cash flow. On valuation, the stock looks compressed. EV to EBITDA at 7.2 times and price to free cash flow around 7.8 times both suggest the market is pricing Kraft Heinz like a low-growth, prove-it-first business. Leverage is not extreme, but it's still relevant. Net debt to EBITDA is about 2.8 times, which is manageable, but it limits flexibility if margins come under pressure or if the company wants to move fast on strategic changes like divestitures or a separation. The profitability picture is mixed. Gross margin is about 33.7%, which supports the idea that the portfolio still has strong brands. But net income margin is deeply negative on a trailing basis, which likely reflects one-time charges, impairments, or accounting impacts, and it's exactly why investors remain cautious. Finally, ROIC around 11.6% suggests the business can still generate decent returns on capital when operations are stable. KHC looks statistically cheap on cash flow multiples, but the market won't pay up until it sees cleaner earnings quality, stable volumes, and a credible path to value unlocking. Now let's look at what Wall Street thinks, and the message is very clear. Analysts are overwhelmingly on the sidelines. Kraft Heinz has almost no bullish conviction here. There are 0 strong buys and only 1 buy, while the vast majority, 17 analysts, rated a hold. And you even have a small group on the bearish side with sell and strong sell ratings. Why does this happen? Because KHC sits in an awkward middle ground. The stock looks cheap on traditional multiples and the business is defensive, but analysts don't see a clean growth engine. Volume trends have been pressured, pricing tailwinds are fading, and competition from private labels and promotions keeps the outlook cautious. At the same time, the bear case isn't straightforward either. This is still a large staples portfolio with resilient demand and meaningful cash flow. That's why most analysts don't want to recommend selling aggressively, but they also don't see enough evidence for a strong re-rating yet. So the consensus hold basically means cheap but prove the turnaround, or deliver a real catalyst like a breakup. And that's it for today's quick breakdown. If you found this analysis helpful, please hit the like button and subscribe. It really supports the channel and helps more investors find these videos. Just a quick reminder, this video is for educational purposes only and it's not financial advice.